Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today I have the pleasure of speaking with Sam Bates. Sam Bates is with Trinity Capital Group, and their company specializes in a lot of new multifamily development. They have done several acquisitions of B-class apartments within Texas, and they own a RV park as well. So they are a extremely versatile, company comprising of just about 800 units right now. They have about 350 under development as well. So today, I think we're going to have some fun learning about the existing acquisitions that Sam has done, and also the interesting facts about the Texas market and how they are branching out into new development. So with that, Sam, thank you for taking time. Welcome to the show.
Yeah, definitely. Thank you for having me on, and I look to add value to all your listeners, and hopefully they learn something from us.
Awesome. So give us some background, Sam, as to, how you got started within real estate and how you formed Trinity Capital Group that you currently, do everything under that umbrella.
Yeah, definitely. I was a finance undergrad, and I thought I was actually going to get my master's in real estate. But after I graduated, I did an internship out in Los Angeles, and I was at a investment bank and private wealth management firm, and I loved the experience, and they offered me a full-time job. So I decided to take it, and I just put my master's on hold. And then after a couple of years, I wanted to move back to Texas, and I decided to get my master's, but at that time I thought I was going to be in wealth management and putting portfolios together for clients through the stock market for the rest of my career. So I got a master's in personal financial planning and an MBA. And then when I graduated, the market had tanked, and I started at a consulting firm, and the work I was doing, I didn't enjoy at all. And, and I quickly realized I wanted to get out of corporate America. So I started getting back into learning more about real estate and just going down that path. And I did some research and found a group in Dallas that I joined, and they were in both single family and multifamily. And I was a limited partner in one syndication back in 2010. And I simultaneously started investing in single family just because I was working a lot of hours and I didn't have a lot of time to put into single family. I only could do 1 or 2 deals a year. So I thought the multifamily syndication route would be the best way to go.
Sure.
And we bought a deal. It was 208 units in Dallas, and what we thought was a prime location, and the actual submarket is pretty much a prime location, but there's pockets within the submarket that I would classify as D neighborhoods.
Oh, wow.
The syndication didn't go as well as I expected. And if it wasn't for the market and just the price appreciation, we probably would have lost money on that. So I decided to focus on single family and just try to ramp that up. And I spent 4 years on that, and I did about 18 single family deals. I did fix and flip, buy and hold. I did a ground up development on a house. And I realized that while the returns could be great, you weren't going to scale like you could with multifamily.
Sure.
And it would be difficult to raise money. So I actually was at a networking event with a guy who I used to work with at one of my consulting firms. And we decided to partner up because he was kind of in a similar situation. He had done single family and wanted to get into multifamily. And so for the next year and a half, 2 years, we looked at small multifamily deals. We tried to acquire them, but at that point, that was 2014, 2015. And then people were saying the market was going to correct or turn probably in 16 or 17. So we were underwriting pretty conservatively. And now looking back at some of the prices that we could have bought deals at, it would have been a grand slam every day of the week.
Right.
But after trying to get deals and not getting them for a year and a half or so, my partner at that time knew a third guy who had real estate experience. He had developed a lot of single family homes. He had developed some commercial and dental offices since 92. So we brought him in as a group, and we had our first development project was a 60 unit apartment and then 10,000 square feet of retail space. And we wanted to do that as a test run to see if we could work as a partnership to see how successful we were. And it turned out that we brought a lot of complementary skills to each other. And it just kind of took off from there. So in the last 3 to 4 years, we've done 12. We're on our 12th project.
Interesting. And thank you for such a detailed, background description there, Sam. And the nice thing about, I think also that you said that there, Sam, is that the first syndication that had challenges, and if it wasn't for the Texas or the Dallas submarket in general, it wouldn't have been successful, right? So, and you also mentioned there, Sam, that within this growing submarket, you still had certain pockets that were perhaps struggling, and you in fact used the word D-class submarket, which typically we assign to extremely impoverished or problematic neighborhoods of sorts, right? So give us some background on that deal, Sam, because I always like to highlight the success, but at the same time, it's always beneficial for our listeners to know that it's not all roses and sunshines, right? I mean, there are so many bumps and challenges, and there are certain syndications, if not done correctly, can really struggle. So I like to maybe dig into that story a little bit and understand what were some of those challenges in that syndication. And when you say D submarket, was that something or D neighborhood, I should say, was that something you did not correctly understand going in initially, that it would be kind of considered a D and a struggling neighborhood of sorts?
Yeah, and the submarket overall, I mean, houses now, back then they weren't selling at this price point, but back now they're probably low end from 400,000 all the way up to over $1 million. And the submarket, or the little niche itself, was kind of apartment row, and there's some pockets within that submarket that, now that I've been in real estate for 10 years, I know is bad. But the general partner on the deal at that time, he had already had 20 years of experience, and I don't think he analyzed how rough that market was. And he had just started his own property management company, and he was wanting to manage it himself. And when we got in there, his team didn't do well with the C, D class tenants. We had gang shootings. We had a property manager steal from us. There's just a lot of things operationally that should have been done better to make it run more effectively. And the GP actually fired himself as a property manager. He brought in a third party. They couldn't do the job, so we had to remove the general partner, and then we brought in a third party property manager, and 2 of the limited partners took over as a general partner.
Wow.
They were, well, one guy, he was basically the CFO of the company that the GP had, so he kind of stepped in, and then we had a limited partner step in, and they were able to turn it around. But I mean, we bought it for, I think, under 20 a door, I think 17 or so, put in all the renovations necessary to get it up to that standard. And right now we sold it in 13, I think. But right now it's trading at probably around 100,000 a unit.
Wow.
So you
That's
can,
how the crazy market is, right?
you can tell just over that 7-year period how significant the market increased. And since the general partner was ousted, we had a bridge loan. So that was really the only reason we sold, because if we could have kept it, I think it would have been a home run, but he wasn't going to sign on the note. So we just had to sell to dissolve the partnership.
Interesting. Thank you for mentioning that detail. Now, Sam, as you indicated, right, the market has become so hot, and sort of the cap rates have compressed. As we all know, the prices are just some crazy high, right? Your company does new construction as well, right? Give us a sense of what it is like to do the new construction, or perhaps what sort of advantages you see over the typical B and C class. Would you rather like do the new construction? So I would love to hear your perspective on that.
Yeah, I think both acquisitions and new construction have their advantages. I think new construction, at least from my perspective, it's the better route to go. It does take a lot of time. Like on one of the deals we're working on right now, it's been literally over a 3-year process.
Wow.
Some obviously don't take that long, but you have to go through planning and zoning, which depending on the city or jurisdiction can take months to years to get approved.
Sure.
You have to, the financing is a lot more difficult to get than just doing an acquisition. But for us, we can get a brand new asset with probably a better tenant base for sometimes a lot lower price per door now than what 19A's product is trading for in DFW. And ours is more secondary and tertiary markets. So we aren't getting the rental rates that a brand new Class A apartment in Dallas would get, but we're getting close, and we're getting like in our 3-bedroom, 2-bath in Kerrville, which is 65 miles northwest of San Antonio, we're getting 1,600, 1,650. So you're getting quality residents that want a nice place to live.
Interesting. No, I know there's definitely, in such a hot market, depending on how you look at it, I think, and you rightfully said that perhaps doing a new construction sometimes makes a lot more sense, and you can give a newer product at an extremely competitive cost as well, right? And now, Sam, your company has acquired several normal B class properties, multifamily assets, right? Give us a sense of how did they come about? I mean, you shared with me earlier that you are a player in the other tertiary markets around Fort Worth area, so you have, let's say, the Weatherstone and Country Place apartments there, right? So how did they come about? Like, how did you find the deals and you finance it and stuff like that?
Yeah, they've all kind of come about different ways, but it's all through broker relationships.
I see.
You have 2 in tertiary markets in Texas, and then one's actually in a suburb south of Memphis, Tennessee, and Mississippi.
I see.
The first acquisition was in Wichita Falls, and it came from a broker who I'd actually been friends with since 2010, even before we were doing real estate. And
I see.
It was a true off-market deal. And I was able to get it at 8 cap. The seller, they had executed their business plan, and they had left a lot of meat on the bone. They hadn't really pushed rents in 2 years. And it was a no-brainer, honestly. But it was in Wichita Falls, which is about 100,000. It's Wichita Falls, especially that property, it's close to Air Force Base. So it is somewhat dependent on the military, but I felt we acquired in 2018, and I felt like with the current administration and just that environment, the military would be a good place to, if a recession was going to happen, government spending wasn't going to change that much, and that base it trained F-14 or F-16 fighter pilots. So I thought I was going to stay.
That's an essential base for sure. Right.
Exactly. And,
I see.
Go ahead.
No, I was just going to ask, like, how much was the price per door, and how did you structure the deal in the syndication?
It was built in 2005, and it was about 70,000 a door. And we syndicated it, and I did it where we could take accredited and non-accredited investors. The lowest investment amount I had was 25,000, and we had to raise about 1.5 million. So it was pretty straightforward. And
how many units was that, Sam?
48. So
48. Okay.
It's a smaller project, but the capital raise was one of the easiest we've done.
Sure.
And it's been honestly the easiest asset that we've bought and managed.
Right.
I feel like it's true mailbox money. And I go up there every month, check it out. I analyze the financials. I have weekly calls with the property manager, but from just an operations standpoint, it's by far the easiest property we have.
I see. Now, give us a sense of, just the area, the tenant base, and it sounds like you have the third-party property management, right? So during your asset management calls as well, Sam, like what sort of metrics and reports you are looking at when you're speaking with the third-party for your property manager?
Yes. I always look at occupancy, especially on the smaller properties. It tends to fluctuate because if one person leaves, that could be a 2 or 3% dip in occupancy. But I'm looking at occupancy. I'm looking at leasing traffic, how many people or prospects we have come in each week, how many phone calls, what rates we currently have, if we need to change the rates on different units. It kind of depends on the property and the situation that we're in. Like a property that we have in Mississippi, we're starting the refinance phase, and in that market, delinquencies are an issue. Tenants there habitually pay late, so I'm focused a lot more on that than I would be in Wichita Falls or Kerrville or even DFW. So
I see.
It depends, but obviously occupancy, cash flow, work orders, things, making sure that the property is running effectively and smoothly are important to look at.
Right. And what about some of the capital improvements? Any like interior amenities you've improved or done exterior work in this? Give us a sense of some of the value add things you may have done.
On all the value add projects we've bought, the exterior unit or the exterior of the property has been pretty great shape. So we've went in and just updated the interiors. Most of them they've either been built in 1996 or 2005. So they were just out of date. So we're going in and doing the cosmetic upgrades essentially.
Sure.
But our biggest renovation budget has been about $600,000, and that's on an 81 unit. And then we have a $590,000 renovation budget on 137 units. So it's going in and just bringing it up to 2020 standard. There's some that we have to do small expenses on the exterior, and like one of the properties was hit by a hailstorm, so we're having to replace part of the roof.
Sure.
But we haven't had the huge go into a 1960 or 70 project where we're having to replace wiring, HVAC or chiller systems and plumbing, things like that.
Right. Now, I know the kitchen and the common areas sometimes play a huge part into our value add, right, Sam? So kindly share with us that what does like 2020's kitchen look like for you, and what sort of cost you are spending in those?
Yeah, definitely. I feel like it's pretty standard for kitchens now to either have black appliances or even stainless steel in some markets. They want either the gray or the white cabinets. Most have handle pulls on them, which a few years ago that really wasn't the case.
Sure.
Putting in backsplash in all units, either granite, quartz countertops, or in some of the lower end areas, you'll resurface the counters just to give it that granite fill. So kind of dependent on the submarket, but
sure,
there is going to be a standard. Put in vinyl plank flooring, and the cost associated depends honestly what you can get labor and then the materials. It can vary greatly. We've started importing a lot of our materials from Asia, so we're getting big breaks on, and we started doing it for all of our developments, but we're going to start bringing it into our acquisitions as well. It's just hard to forecast because it'll take 8 weeks, sometimes 12 weeks to get product over. And if you acquire something, you want to start on the renovations immediately.
Sure.
On like our latest renovation project, we're averaging probably about 4,500 a unit turn, maybe 5,000 depending on the size. But in DFW specifically, I know some people are putting 7,500 per unit turn. There's a couple groups that have 20, 30, 40,000 units. They're even sinking in 12,000 a unit.
Wow.
So it depends on kind of what all amenities you need to provide to that market.
Sure. And that cost, Sam, is inclusive of the efficiency or the cost advantage you get by importing the material from Asia, or is that that import thing like fairly new that you're doing?
We've been importing for over a year from Asia, but the renovations from the acquisitions, we've yet to import. Most of the appliances or fixtures or flooring, we've imported flooring on all 3 of the renovations. We've imported some flooring, and some of it we've had to use from outside vendors.
I see. So floorings, fixtures, I guess I assume black splashes are pretty much all imported, I imagine, right?
Yes.
How about granite also? Are you importing any granite? Yeah.
We are for our new builds. Well, actually not granite. We're importing quartz.
Quartz. Okay. Got it.
From getting it from Asia, we can get quartz at the same price or maybe even a little bit better than what we could get granite for. So we felt like it's just the newer standard that people want. And we can get it for the same price. We might as well import it.
I see. So I would like to, maybe perhaps ask a couple of questions around it. Sam, is that what sort of cost advantage you're seeing by importing? Is it like 50%, 70%, 30%? Give us a sense of that.
Yeah, it depends on obviously the product, but yeah, we're seeing across the board 30 to 50%, and the quality is better than what we could get in the US.
I see.
Or what we're buying. We luckily had some connections where we went over to China for 2 weeks and went to different factories and vetted the factories before we started buying the products. Just to see, because everybody over there has a different standard of quality control, and we wanted to make sure that the products we were importing were great quality.
Right.
And luckily, we were able to do that with that visit, and we haven't had any issues since then. Like once we got back, the tariff wars with China started. So the quartz we're buying is actually coming from Vietnam, but it's from the same group or the same company that we were going to buy it from China. They just moved to Vietnam.
I see. Interesting. Thank you for sharing that. And also, Sam, when you're buying these, right? Obviously the material comes in bulk, so you have to kind of work through the issues of storage and sort of the ticketing, meaning how much is going out the door and making sure that the correct amount is getting applied or used within your unit, and not the contractor is not like taking off and walking and taking it somewhere else and being used at some of his other jobs and whatnot. So how do you manage all that aspect, the storage and all of the inventory associated with it?
Yeah, it is a process, and you do have to have it planned out before you just start importing.
Sure.
Even if you have contacts over there, one of the harder or one of the biggest issues, at least for us, is you have to pay 50% of the order as soon as you place it. And then before it even leaves the port over there, you have to pay the other 50%. So you're fronting that cost for 4 months sometimes before you even get the product. But we have a warehouse where we store all the product. And since one of my partners is the developer, he oversees all the contractors and oversees all the people that are working on his jobs. So from an inventory perspective, we can keep count and keep track of what goes where. And we have about an 18,000 square foot retail or warehouse. So segment the different jobs into sections of the warehouse. So it's a lot easier to keep track of than if it was all lumped together and you would have a random GC or random sub going in there and pulling out material.
Sure. Thank you for sharing that details, Sam, there. And also regarding syndications, Sam, how are your deals structured? Meaning, like LP, GP shares, if you are offering any preferred returns or waterfalls and things like that?
Honestly, we've done quite a few syndications now, and they've all changed in various ways.
Sure.
The first syndication we did was an 80-20 split. With no preferred return. We've done 2 like that. We've now done a few 70-30 splits with an 8% pref. And then on one of them, we had to front 600,000 or 700,000 up front. So we did a 60-40 split. And,
wow.
And our investors were completely fine with that. And we took on all the risk up front, and we felt like we should be compensated from the back end, but they're still getting a return greater or projected return greater than 20% IRR. So they're happy with that.
Right. Those are handsome returns for sure. Also, Sam, now that we are in the midst of COVID crisis now, right? I mean, as we all know, a lot of jobs for the tenants have been affected, or sometimes, the hours at their work has been reduced. So there are, some of the ripple effects we are starting to see on our books as far as, whether delinquencies or lateness and things like that, right? So I'm curious to know your thoughts on, like as we move forward, let's say we are into like September, October, or perhaps year end, right? So when we are like looking at these deals, right, how do we make sense of the NOI, right? Because we don't know what the stable performance is, right? So I'm curious to know your thoughts as to how do you sense like some of the deals and what's going to transpire in the coming months?
That's a great question. I wish I had a crystal ball. I think I could become a billionaire if that was the case. I don't know. I will say June collections have been the worst so far that we've experienced in our portfolio. And I don't know if that's a trend that's going to continue or not, but I feel like the longer COVID occurs, the more people are either away from their job or they've gotten furloughed or laid off.
Sure.
It's going to impact the economy more significantly than it has in April or May. Like, I know everybody was worried about April collections, and there was really a small blip, if anything. So if COVID continues, or we do have a second resurgence, I don't know, October through December could be difficult. I personally have underwritten only a handful of deals since COVID started. And my growth rate, I've reduced significantly.
Sure.
Like some of the growth rates I had at 0% for year 1 and year 2. I don't know exactly how it's going to impact, and I've listened to quite a few people, and with interest rates where they are, where capital's leaving possibly the office space, where capital is coming in from other countries, from even the coast with all the opportunity funds, I think cap rate could even compress more than what they are now. So underwriting a deal is very tricky, and that's one of the reasons why we plan on not buying anything for the immediate and maybe even a little foreseeable future, because we just don't know where the market's going to go.
No, that's very true. I mean, and you rightfully said that. I mean, given as resilient the multifamily class is, and obviously we all know what office and retail sector are experiencing right now. I mean, all of that capital is going to pour into multifamily. So, I mean, already the hard situation of multifamily just made a lot more worse, I should say, right? So interesting. And did your group halt any renovations or any like big capital projects in this pandemic, Sam, or you were largely unaffected?
We haven't halted really any renovations for a couple reasons. The two projects we're currently renovating, one, we're in the refinance phase and we're refinancing into a HUD loan, and we want to be done with the renovations before we close the refinance. And we feel like we're 60% through, 70% through, so it won't be an issue. And then on the other project, we still been getting rent bumps. So we're renovating units as we can, and we've ordered product. And once we have like 20 to 30 units left before the product runs out, and once that happens, we'll reevaluate and assess if we should continue with the renovation program or stop. But at this moment, we currently haven't, just because we feel like we want to still achieve that plan. Now, if we weren't getting rent bumps on the renovations, we'd definitely stop. But we have stopped distributions just to have that extra cushion in the bank if for something that happened in October or December, even next year, where we don't want to have to go back to the investors and ask for more capital.
I see. Great advice. Also, Sam, your group is mainly headed by your three partners, right? Give us a sense of, what is everyone's sort of strong superpower, and, how are you sort of aligning with each other and doing different activities within your company?
Okay. One of my partners is Daniel, and he's been in construction since '92. He started out as a frame carpenter and has just built businesses. So he handles our development side. And then the other partner, Michael, I met at a consulting firm, and he's a CPA, and he handles taxes, and then he does a lot of investor relations and raising capital. He owns a Chick-fil-A, so he has a lot of contacts through Chick-fil-A and other networking events that he goes to. And he also looks at operations sometimes. And I handle more of the finance, operations, banking, dealing with lenders, dealing with attorneys. So that's how we've structured the partnership. I handle a lot of the day-to-day things, and they handle some of the other aspects.
I see. And so acquisitions come through you as well, basically, or all three partners are combining on acquisitions?
I underwrite all the deals. Like last year, we closed on one acquisition. I underwrote at that point, I'd underwritten 110 or so deals.
Wow.
For the entire year, I looked at 170, and we acquired one. So it's maybe I underwrite too conservatively. I would rather do that and not have the chance of losing somebody's money.
No, and actually, you're right, Sam, that I have heard the same sentiment from a lot of other investors as well, that we are looking at 100, 125 to perhaps narrow down the 5, and we are buying like 1 or 2. So your run rate is absolutely the same. Like, you're looking at several hundred before you're buying on a few of them. So definitely. So before we go, Sam, you are a seasoned investor and you have seen many deals, you have networked a lot. What can you share the best advice to a lot of aspiring multifamily investors?
One specific word of advice would be tough to give, because there's so many pieces to this puzzle, especially if you don't have a team in place. I mean,
Sure.
if you don't have a team just on one acquisition, there's going to be a lot of moving parts and pieces. But I think at least what has helped me succeed is I'm a constant learner. I feel like I continuously read, continuously learn, listen to podcasts, and I get ideas, or it just helps me learn and grow the business. And also networking is essential. I mean,
Sure.
some weeks, especially obviously before COVID happened, but some weeks I'd be networking every night of the week. And you just have to grow your network. You have to talk to brokers, talk to investors, vendors. It's a continuously evolving space. I feel like over the last 10 years, multifamily has grown tremendously, and it's for a lot of reasons, but there's so many players that you need to be interconnected with a lot of people and know people. And I think some of the deals we've gotten has just been through our connections.
Interesting.
Some of the land we've bought or got, we would have never got if it wasn't through the connections we had. So I know the cliche is it's more about the people you know than what you know.
Sure.
But I think if you can marry both of them together, that's going to be a lethal combination.
Great advice. Great advice. Wow. You added a ton of value, Sam. Thank you for all that knowledge of yours and sharing with our listeners. Before we go, tell our listeners, how they can sort of locate you and learn more about your company.
Yeah, definitely. You can reach me at sam@trinitycapitaltexas.com, or you can call me at 972-855-7654. And I'm on LinkedIn and Facebook. I don't always get on it, but I usually respond to email or phone call a lot quicker.
Awesome. Thank you, Sam. It's been a pleasure. As humble as you are, you have a wealth of knowledge, and your curiosity to share, the nuggets of information is absolutely appreciated. So I thank you once again, and I look forward to, many more projects from you and learning more about them. So you've been a great guest. Thanks a lot for coming on.
Well, thank you for having me, and I look forward to speaking to you hopefully more in the future and sharing more information that I have.
Absolutely. Absolutely. Thank you so much.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.